Well, good afternoon, ladies and gentlemen, and welcome to this afternoon's Retirement Masterclass hosted by Russell Investments. My name is Martin Kennedy, I'm the Head of Education, and I'm presenting to you today from the Russell Investments office here in Melbourne. I hope wherever you're joining me from this afternoon that you are safe and well. Now, the idea of the Retirement Masterclass is to give you, our members, access to some of the expertise and experts that we have when it comes to managing your retirement savings. This afternoon, you are going to hear how to supercharge your income by using some smart strategies in retirement. And we've got a very special guest speaker to talk to you this afternoon. Before we do that, I need to do a couple of housekeeping bits and pieces. And the first one is that today's session is being recorded, and a copy of the recording will be made available after the session itself. The session will run for approximately 30 minutes, give or take thereabouts, depending on any questions that we get. Now, as you've joined, you might notice that you have been automatically muted and don't have the ability to take yourself off mute. That, of course, helps us cut down on background noise and the like. But please don't let that stop you engaging and asking any questions that you might have. You should see a questions tab there, and feel free at any point during the presentation to type in and ask your questions. I'll acknowledge the question. If it's appropriate, I'll answer it there and then. Alternatively, I will hold it until the end of the presentation, but we will make sure we get all of your questions answered. Before we get into the detail, I do need to highlight that all the information in today's presentation is general financial information only. That means it doesn't take into account your personal circumstances. Please consider it in light of your circumstances before acting on any of the information. And if you do require personal financial advice or guidance, it is available by contacting the fund on 1800 555 667. I'll come back to that again a little bit later. With that out of the way, what are we going to hear about today? Well, first of all, I'm going to quickly give a quick recap on the purpose of super and pension account, because with everything that's going on in super and pension space, we can get lost in the clear purpose, and these do have a very clear purpose. I'll talk reasonably briefly around recent market volatility. Of course, in recent weeks, we've seen some, pretty steep movement. Our last masterclass, which was held on the 23rd of May, was actually about investing and investment markets. I'm just going to touch on a couple of those pieces. More importantly, we're then going to hear from Paul Basso, who works for Link Advice, and Link is Russell's advice partner. Paul has a lot of experience. I'll introduce Paul properly a little bit later, and he's going to talk to us about some smart strategies as we're both approaching and in retirement to boost our retirement savings. All right, with all of that out of the way, let's now get in and start talking about the presentation. So the first thing I would like to talk about here is the purpose of super. This does tend to get lost because we tend to in super talk very much about the individual actions that you, our members, can take. Super has a very clear and defined purpose, and that is to pay you an income in retirement to help you live the lifestyle that you want. Now, superannuation, of course, as we're working, there are compulsory mandated contributions that our employer must make. As we know, these are now increasing up to 12% over the next few years. On the 1st of July this year, for anyone still working, your employer must contribute up to 10.5% of your ordinary time earnings. You may also have at retirement some voluntary savings, whether it be an investment property, a family trust, or just some money in the bank. And of course, when we talk about sources of income in retirement, we will also include in this your own home ownership. Of course, these are both supported by the government age pension. As we can see there, the government age pension, it's not a lot of money, and most of us might aspire to a higher standard of living in retirement than the government age pension will provide. And so our compulsory super and our superannuation savings are likely to be one of the biggest, if not the biggest, sources of income for us to create an income in retirement. Now, the mechanism for this looks exactly like this. During our working lives, we have a superannuation account, and a superannuation account is designed to receive money from your employer, from yourself, and it does so on a concessional tax basis. That is, money that comes into it, if not previously taxed, so income tax, will simply be taxed at the superannuation rate of 15 cents in the dollar. The investment earnings in superannuation are also taxed at 15 cents in the dollar. There are rules around the amount of money that can go into superannuation, such as the concessional contribution limits, which for this financial year talk about things such as, say things, the limit is $27,500 of before tax money. So that's money that you haven't paid income tax on. It would include any employer contributions, salary sacrifice contributions will simply be taxed at 15 cents in the dollar. When you retire, you simply move your money from a superannuation account to a pension account. And a pension account is designed to pay money back to you. Both investment earnings and payments to you coming out of your pension account are totally tax-free, meaning it's the tools that the government want you to use to both save for retirement, and then in retirement is a superannuation account and a pension account. Importantly, it's your money and you stay in control. And in both a superannuation account and a pension account, your money is invested and you have a choice of how your money is invested. Now, of course, as I started and said, we've recently seen some extreme volatility in investment markets again. And so I just wanted to spend a couple of minutes now talking about investment markets. And I can already see there are some questions coming in. Thanks, Simon. I'll answer that a little bit later. So the first thing I want to do is talk about the cycle of market emotions. And for anyone who joined us for the first masterclass, might remember Alex talking about the cycle of market emotions. And this is how at any point in time, how we will feel about different investments. Now, not that long ago, there was euphoria because we were all getting nice big investment returns. Markets were performing well. Since then, of course, we've seen markets drop. Anxiety, fear, panic, and perhaps now we're somewhere near despondency. But as our emotions change, when we look at investments, it creates both opportunity and, of course, times of great risk. Because when times are going well and we think, right, because this is performing well, I'm going to put more money into it. When markets drop or fall, as we've seen in recent times, and we might be feeling rather despondent or panicking a little bit about it, it's a time of great opportunity. Now, the other thing to remember, of course, is the value of diversification. While we have seen extreme movements in markets recently, it's very rare that a couple of years in a row, the same investment category will outperform another. As we can see over a long period of time, there are great swings on what performs best, whether it be international shares, whether it be local shares, whether it be property, or whether it be a balanced style fund. We will see lots of variations in both best performing asset class and worst performing asset class. Now, what this really tells us is to get a smooth return, we must diversify. The last thing I want to talk about here before we move in is, of course, to understand the behavior of money, because money has quite predictable behavior. What we're actually looking at here is the value of $1,000 invested back on the 31st of December 1979 and what it would have been worth as at the 28th of June 2019. I'm sorry, I know this slide is a couple of years out of date. Ideally, it would be totally up to date, but the message here is a strong one, and that is around the behavior of money. And so if we look at the value of our $1,000 over a long period of time, the first thing is, it must today be worth $4,610 to have kept pace with inflation. If I just want a guaranteed return on my money, in fact, I want to never see it go down in value, well, you can do that. You can invest in cash, like earning an interest rate from a bank. But over a long period of time, it's the worst performed asset class. At the other end of the scale, all the shares and growth assets are the best performed. But the whole way along, they've been up and down in value. And of course, when making an investment choice, we really need to understand if I'm looking for growth and I want that growth, I need to understand that it will go up and down in value. If I want a smooth return, well, you can also achieve that. Of course, one of the worst things we can do when we go back to the cycle of market emotions is once markets have dropped, then take our money out. Because by doing that, we are just locking in our losses. You might have some more questions about investing, particularly as it relates to your pension. You, as a member of the Russell Superannuation Fund or Pension Fund, you have access to over the phone personal financial advice. All you need to do is pick up the phone and call us 1-800-555-667 and book an appointment to speak with a financial advisor who can talk to you about your personal circumstances. Based on those circumstances, we'll make a recommendation to you. We'll actually make that recommendation to you in writing to make sure that your account is doing exactly what you want it to do. All right, now with that out of the way, and I've probably spoken there for a little bit longer than I intended to, what these things do though, when we see market volatility, it creates opportunity. With investing, what everyone always says, I wish I'd started early. When a market drops, what it does is buy us some time because we're able to buy back in at a cheaper price than everything has been. And really what we are talking about today is opportunity. And so to talk about opportunities and particularly smart strategies approaching retirement, I'd like to introduce Paul Basso. Paul is an advice coach with Link Financial Services. Paul, if you would hear, I better pop an earpiece in so I can hear you. Paul, can you hear me there?
Yes, I can, Martin.
Hello, Paul. Welcome. Thank you. Paul, do you also, would you like to turn your camera on just so everyone at home can see you? There you go. You've done that now. What I'm also going to do is turn my camera off, and to everyone on the line, I'll leave you in Paul's hands. I will just highlight, I'm controlling the slides here, so Paul might need to say, hey Martin, next slide, and I will do that. But Paul, that's enough from me. Thank you, and over to you.
Great, thank you, Martin, and hello everyone, and thank you for joining us this afternoon for the webinar. It's great to have the opportunity to share with you details of 4 recent superannuation rule changes that can help members to top up their super savings in the years leading up to or in retirement, and therefore benefit from the concessionally taxed superannuation environment. Before I commence, it's important to note that the content of my presentation is of a general nature and has been prepared without taking into consideration your personal circumstances. Therefore, before acting on the information presented, please seek advice from a financial advisor. Okay, the first contribution opportunity we'll look at is called downsizer contributions. For some individuals, selling the family home and downsizing is one way to release the equity they have built up in the family home and use it to help fund their retirement. The introduction of downsizer contributions provides eligible individuals with the opportunity to use the sale proceeds of their home to contribute up to $300,000 per individual or $600,000 per couple into their super account and benefit from the concessionally taxed super environment. Some of the benefits of making downsizer contributions include it provides the opportunity to top up superannuation balances. Importantly, there's no obligation that the individual is required to actually downsize their home. In fact, there's no requirement they have to buy another home. Depending on the individual's circumstances, making downsizer contributions may help increase Centrelink entitlements as their super balance is exempt from the assets test until the member reaches age pension age. Downsizer contribution is not subject to the current $1.7 million total super balance restriction. What that means is individuals that have already reached or are close to reaching that cap can still top up their super by making a downsizer contribution. Let's now look at the eligibility criteria to make downsizer contributions. Well, the good news is there is no work test requirement or age limit that applies. So someone who is already retired, and let's say age 75, for example, is still eligible to make a downsizer contribution into their superannuation account. From the 1st of July this year, the minimum age has reduced from 65 down to 60, making more members eligible to make downsizer contributions. The property itself must have been the individual's main residence at some point and owned by the contributing individual or their spouse for at least 10 years, and the property must be in Australia. Sale proceeds must be either exempt or at least partially exempt from capital gains tax under the main residence exemption. So what this means is that the individual does not have to have lived in the property for the entire 10 years. For example, it may have been used as a rental property at some stage during the 10 years. Some important considerations regarding the making of downsizer contributions include: it's important to note that contributions to super cannot be accessed once contributed unless the member meets certain requirements. The downsizer contribution is added to the individual super balance. Therefore, it's included in the assets and incomes test to determine eligibility for the age pension. It's important to note that the family home, however, is not counted as an asset. Therefore, making downsizer contributions could impact existing or future age pension entitlements. Individuals can only access the scheme once, and the contribution itself must be made within 90 days of receiving the sale proceeds, generally 90 days from the settlement date. An extension may be applied for in limited circumstances, for example, situations of ill health. The contribution itself is not tax deductible. Therefore, individuals with potential tax liability may benefit from other forms of super contributions. And to make the downsizer contribution, the individual must complete what's called a downsizer contribution into super form. It's available from the ATO website. So they complete that and must provide it to their super fund either before or at the time of making the downsizer contribution. Let's now look at the second contribution opportunity, which is called the bring forward arrangement. It allows individuals to contribute up to 3 times worth of the non-concessional contribution in one financial year. This means a member can contribute up to 3 times the annual cap of 110,000, meaning they are able to top up their super by $330,000 in the same financial year, subject to eligibility. Non-concessional contributions are basically voluntary contributions made by the member from after-tax dollars, for example, from bank savings. Now, the benefits of utilising the bring forward arrangement includes, once again, the opportunity to increase one's superannuation balance before or during retirement. If you receive a financial windfall, such as an inheritance, or sell an asset of considerable value, it provides eligible individuals with the opportunity to contribute up to $330,000 into their super without constraints of the usual annual contribution cap of $110,000. From the 1st of July this year, it's available to members up to age 74 without the need to meet the work test requirement. Now, I'll touch on the work test requirement a little bit later. Currently, only members aged under 67 can take advantage of the bring forward rule. So there's a real opportunity from 1/7 for members up to age 74 being able to take advantage of this opportunity without having to meet a work test. If we look at the eligibility criteria, it's important to note that the maximum amount that a member may be eligible to contribute under the bring forward arrangement will depend on what's called their total super balance, or TSB for short. Now, the TSB, total super balance, is the total value of members' superannuation interests as at the 30th of June of the previous financial year. So if we look at the table below, the table outlines what is the maximum non-concessional contribution limit that applies based on a member's total super balance. So if we look at one example, if we look at the first row, where the member's total super balance is under 1.48 million as at the 30th of June, the previous year, the maximum non-concessional contribution the member is eligible to make is the full $330,000. If the member contributes the full $330,000 in one financial year, they are then not eligible to contribute any further non-concessional contributions in the next 2 financial years. The other important requirement is that the member must be aged under 75 to take advantage of the bring forward arrangement. The third type of contribution opportunity we'll look at is called the carry forward unused concessional contribution. Now, these type of contributions allow individuals to make extra concessional contributions above the annual concessional contribution cap. Now, when we talk about concessional contributions, they are pre-tax contributions into super. So they include, for example, salary sacrifice contributions, employer SG contributions, that's a superannuation guarantee, or it may include personal contributions that are claimed as a tax deduction by the member. Now, the current annual cap for concessional contributions is $27,500. Now, there are a number of benefits of taking advantage of this opportunity, including there's a potential to reduce tax due to the concessional tax treatment of super contributions. It provides members with the flexibility to make larger concessional contributions when it suits their circumstances. There's the opportunity also for members to make up for missed contributions of the past by making larger salary sacrifice or personal deductible contributions moving forward. How does it work? It involves the member accessing the unused concessional cap amounts from previous years to make extra concessional contributions above the general concessional cap in the current or subsequent years. Now, members are able to use the unused cap amounts starting from the 2018-2019 financial year. The unused cap amounts are available for a maximum of 5 years only. For example, the unused cap from 2018-19 financial year, for example, will expire in 5 years. So that will expire at the end of 2023-24. So in short, if the member doesn't utilize the unused cap, it's basically lost after 5 years. So it's use it or basically lose it, unfortunately. Now, to use the unused cap, the member must have a total super balance of less than $500,000 as at the 30th of June of the previous financial year. If we look at a simple example, Christine's concessional contribution cap for the 2021 financial year is $25,000. Her total concessional contributions during that year, i.e. her employer's superannuation guarantee contributions, they totaled $15,000. Therefore, her unused concessional cap for the year is $10,000. And that's calculated simply the 25,000 concessional cap minus the 15,000 that was paid in as SG contributions, leaves the $10,000 of unused concessional cap. Christine can utilize that unused cap of $10,000 to make a larger concessional contribution in a subsequent year, as long as it's within 5 years. The fourth opportunity we'll look at centers around a change to the work test requirements that take effect from the 1st of July this year. Now, under the current rules, members aged 67 to 74 are required to meet the work test in order to be eligible to contribute to super. Now, the work test requires that the member must have worked 40 hours in a 30-day period. So that's the qualifier for the work test. Now, this requirement meant that members over age 67 who had already retired from the workforce were ineligible to make contributions, personal contributions to their super. Now, what's changing is from the 1st of July this year, members under 75 are now able to make personal contributions without having to meet the work test. This provides many benefits, including increased flexibility for members to contribute to super or to the super environment later in life, even once they have retired. And this may benefit those members that have retired and subsequently received a financial windfall, such as an inheritance, they can now contribute amounts to the super without having to meet the work test. And that rule changes from the 1st of July this year. That concludes my presentation. I hope you found this brief overview helpful and hopefully presents you with opportunities to consider. As I mentioned earlier, please seek advice from a financial advisor before implementing any of the contribution types we've discussed in this presentation. Thank you, Martin.
Thank you, Paul. That was wonderful and really wonderfully in depth at that level. I should say Paul is one of the very senior advisors at Link Group. Paul has over 34 years experience in the industry, as well as 13 years at Link. That was really beautifully explained, Paul. So thank you very much. And I think, you know, what you've really highlighted there well is that there are some unique and wonderful opportunities, whether it be the downsizer, the bring forward for non-concessional contributions, the carry forward for concessional contributions, or of course the work test itself. I can also see we've got a couple of questions that have come through, which I'll address shortly. What I will do, Paul, for the moment is just turn your camera off and your microphone, because we are sort of right on time. My fault, I talked a little bit long, just so for anyone who's rushing, I'll quickly finish up and then we'll come back and address the questions. So the first one is, again, this is a series of retirement masterclasses where the idea being that we give you access to our experts like Paul, so you can hear and share in some of their expertise and hopefully get some ideas of some next steps. The next one coming up a month from today, so Thursday the 21st of July, where we're going to talk about your entitlements. So whether that be Centrelink, what that might look like, whether you're hoping to get the age pension, all those different benefits, whether it's just a healthcare card. If you haven't yet registered, you can take your phone out if you've got it handy. QR code there on the screen, should be able to come in, click it and go and register. If not, there will certainly be more emails coming. Also, from an information perspective, you have the power to control the information that you see from your fund. We've recently launched what we call Zest. Zest is a customized and feel-good platform for you to be able to design the information that you see. There's no point, you know, super funds traditionally have produced a magazine, might be 60 odd pages, half of it or maybe more won't be relevant to you. Using Zest, you can control both how often and the type of information that you see. Again, QR code there. If you want to go in and register for Zest, please do so. Just before we finish, two more things for me to say. The first one is when we do finish, a new window will pop up, which is the post-seminar questionnaire. It's just a couple of questions, will take you no more than 60 seconds to complete. We greatly appreciate any feedback or thoughts you've got on the sessions. These sessions are about you, and we want to make sure that the information is valuable and useful. We'd love any suggestions, including on time of day that suits you best. Last one from me before we get to the questions. Again, just to highlight that all the information in today's presentation is general financial information only. It hasn't taken into account your personal circumstances. Please consider it in light of your circumstances before acting on any of the information. And if you do need personal financial advice or guidance, don't be shy, pick up the phone and call the fund 1-800-555-667. All right, with all the formalities out of the way, again, thank you very much for your time. I do hope there has been some